Aloha, good morning, everyone. Welcome to our webinar titled Residential Real Estate in the COVID-19 Era. If you don't know me, my name is Isaac Tawaefa, and I'm a business development officer with MBL Title, and I oversee a lot of the business development efforts on the residential side for our group. With 4.5 million positive coronavirus cases in the U.S. to date, many facets of the economy and everyday life, to include real estate, have been significantly impacted. And while COVID has definitely caused a lot of economic turmoil, there are still some really bold and resourceful people in our industry pivoting and finding opportunities, not just to survive these times, but actually finding ways to succeed in this environment. So I have the distinct pleasure of getting to host a few of these bold and resourceful people this morning. I'm grateful to share the next hour with these panelists and with all of you who joined in and who will watch this once it's recorded. So our first speaker is Clint Nolen. Clint is co-owner of and advisor to Nolen Homes, a design-build firm focused on high-end single-family homes, primarily in the Park Cities, Preston Hollow, and Lakewood areas of Dallas. Nolen Homes specializes in home remodels, new construction, and interior design, as you can see by Clint's picture behind him. Clint is also the managing partner and co-founder of Kalterra Capital Partners and Kalterra Construction, which is a private real estate development and construction company located in Dallas, and focuses primarily on multifamily residential and mixed-use development across Texas. Our next speaker is Trevor Reed. Trevor is a multifaceted expert in real estate and investing, overseeing a portfolio of apartment complexes and single-family residences as an asset manager for M Properties has helped him specialize in property management on all levels. Trevor is also an active investor, a realtor with Northbrook Realty Group, and a loan officer with NXT Mortgage. Next up, we have Tucker Bomar. Tucker is a top producing real estate agent with Compass. With years of experience representing clients in Dallas, he has a keen understanding of the Lakewood, M Streets, Oaklawn, and Park Cities markets. In 2015, Tucker and a team of fellow realtors successfully marketed the sale of the house condos at 2200 Victory Avenue in Uptown, selling over $50 million in residential high-rise units. And last but not least, we have Tyler Hodgson. Tyler is the founder and chief loan officer of NXT Mortgage Company. Prior to mortgage, Tyler served in the U.S. Marine Corps as an artilleryman, and in 2016, in December, Tyler founded NXT, where he now has a team of over a dozen loan officers that he oversees and is among the top producing loan officers in the country. In addition to mortgage, Tyler is also an active real estate investor and a minority partner in a small CPA firm, Hoidgson Nash CPAs. So just a quick note about the question and answer function. I'll have access to the sidebar. So if you want to ask questions to the panelists, I'll be able to feed some of those in, time permitting. And I would love for you to ask them questions, and I'm sure they would too. So don't be shy about being active in asking questions to these guys. So with that said, why don't we just hop right in and start with Tyler. 30-year fixed mortgage rates recently dropped below 3% for the first time ever, which is increasing demand from home buyers. And so I wanted to get your thoughts on like how that's affecting borrowers' buying power. Hey, Tyler, I think can y'all hear him?
No.
Okay.
There we go. Mute.
Yeah, okay. Go ahead, buddy.
I try to mute myself when I'm not talking. So remind me if I start talking
okay.
and I'm muted. So you just missed the most important things I was going to say, and I'm not going to repeat it.
Okay, thank you.
So 30-year fixed rate is now average 30-year fixed rates below 3%. It's like 2.875, 2.9 range for the last couple of weeks actually, and they've been teetering around that 3.0 level for the last couple of months, thanks to Fed stimulus, along with Fed dropping interest rates, and they're trying to stimulate home ownership, home buyers, and the refinance market. So to answer your question about how it affects home buying, I wrote down a couple, just a scenario. So interest rates are about 1% lower today than they were last year. So if you had a $250,000 mortgage, $250,000 loan amount last year at 4%, you would be paying $11.94 a month for the mortgage payment. Obviously, your taxes and insurance on top of that. And if you got that same mortgage today, bought that same house for $250,000, your monthly payment's now $1,054 per month. So that's $140 per month less taking out the same loan amount today, which is pretty substantial. That's more than 10% savings. It's like a 10% discount on your mortgage for no reason. So with that, you have more buying power as well. So if you got that $250,000 house last year, I can buy a $283,000 house today for the same monthly cost as you bought that house last year, obviously outside of taxes and homeowners insurance. So it's $33,000 more. Again, that's more than 10% increase with just a change in interest rates. So that's one way that the Fed kind of controls that demand and supply of the housing market to make sure that we don't have a housing collapse and that we stay high. So,
yeah. So have you seen, has there been an uptick in business since the drop in rates? Like, I know you just laid out how it's like advantageous for people, but like, have you seen an uptick from that? And if so, like, what is the makeup between refinances and purchase loans? And
yeah, so definitely an increase. Pretty much all the mortgage metrics month over month and week over week and year over year have been increasing, corresponding with that drop in interest rates. Where lenders are really getting slammed right now is the refinances. So while purchase business is kicking back up in May and June, there was a substantial drop in March and April. Obviously, as many people weren't out looking at houses, so they weren't buying at that time. But in May and June, there was huge increases. Refinance applications are up 121% at this time versus where they were last year. So if you think about that, every single mortgage lender that did 100,000 loans last year, now they have to do 221,000 loans, and they probably didn't double their staff. So there's some bottlenecks in the industry right now with processing times and getting these loans closed and taking care of the clients quickly to take advantage of these rates while they still can, because who knows what's going to happen a month from now or 2 months from now. But yeah, refinance business has boomed. As of an article on CNBC last week, the average mix right now is 65% of mortgage applications are refinance and 35% are purchase. NXT Mortgage, historically, we've been about flip-flop. So we're normally about 65% purchase and 35% refi, sometimes even 70-30. And within the last couple of months, we've been like 50-50. So our refinance application has definitely increased. Purchase is probably on par with where it was last year, or slightly higher, but the refinance has doubled, so it takes up a larger portion of the total mix.
yeah.
So hopefully that answers your question.
Yeah, no, totally. And actually, so I've kind of observed just from the title perspective, like it seemed like a bulk and a majority of the business that was coming in during the time, like right after the lockdown until about like the end of April and the beginning of May, like that, it seemed like a bulk of that was refinances. And so I was curious about some of the factors like contributing to people wanting to refinance. And so if you could just like really quick about like what is the makeup of those refinances? Are people trying to get cash out? Are the cash out refinances, or like what is the thinking, I guess, kind of behind? What's
there have been some people there's been some people with motivation to do a cash out refinance. Home equity is at an all-time high in the United States, like X number of $1 trillion of home equity right now. So we've had a lot of people cash out to just have liquidity available, maybe trying to consolidate some of their other debts because the uncertainty of their future income and the economy, as well as, I've had plenty of real estate investors cash out refinance to go buy more properties because they think now's the opportunity to get some other properties at potentially a discount. So we have seen some cash out. Now, I would say lenders on the underwriting side and pricing interest rates and risk, they're more strict on cash out refis right now because they have some concern as well. So it's been a little more difficult doing cash out refinances in the last couple of months versus pre-COVID.
Right.
So just more strict guidelines and things like that. But I would say the majority, so cash out refinances have been there, but the majority is just your typical person who bought a house within the last 6 months or the last year, or any time really within the last few years. And they're just looking to take advantage of the lower interest rates. It lowers their monthly payment. Some people are dropping term, down to 15-year or to a lower term and keeping that payment about the same. So, why not? So yeah, there's a wide mix in what people are doing with the refinances, but it's definitely a benefit, and that's going to help stimulate the economy too, because if you save $200 a month on your mortgage, that gives you $200 a month to spend somewhere else.
Right. Yeah, no, that's really insightful. I appreciate you sharing that. Thanks for shedding some light on that. And that will lead over kind of into the next question that I have for Tucker. Tucker, we spoke the other day about some of the factors affecting the market, and you had some great insight on what those were and how those factors were motivating buyers and sellers. Could you expand on some of those things? We discussed a few things like discretionary spending and whatnot.
Sure. Can you hear me good?
Yeah, we can hear you.
Cool. All right. Yeah. So, there's really a confluence of several factors. I think one of the biggest drivers right now is obviously low interest rates, but what you can get relative to renting. And so, you've got a ton of people in apartments right now, and from 25 to 35 demographic, and they're looking at what they're paying in rent, and they're looking at the sort of how COVID is kind of affecting our psychology of how we want to be close together, or we want to be more far apart, and these sort of factors are affecting people's mentality of, what am I paying in rent? I'm in a 150 unit apartment building, and rates being where they are, you do that math and you say, well, it makes a lot of sense for me now. One, I don't want to be using the same elevator as 150 other people, and two, there is a good amount of new construction, what I guess you would call entry level, for like the young professional market in the urban markets. So that really is driving a lot of activity. I think, people last year in, October, November, December were thinking about moving this year. And typically most people are targeting that March, April, May time zone to sell their house and find another house to move to. And obviously in March and April, there's just like not much going on. And a lot of those sellers have put it off until next year, which would just kind of constrain the inventory levels. And so first time buyers really don't have as much selection as they otherwise. Although I'd say in Dallas, at least, we've had low inventory for years now, but inventory is even at a lower point than it's ever been. And so you've got low inventory, you've got a lot of young buyers, a lot of first time buyers trying to buy in good school districts if they have kids, if they're having a baby and whatnot. The other side of it is discretionary income. People can't go out and spend money on things that they used to, like going to dinners or hanging out at bars with their friends. And so, if they spend $400 a month on going out and having fun with their friends, they're thinking, well, what could I do with that extra money? And what kind of house does $400, additional to what I'm paying right now do for me? And so I think a lot of people are shifting their discretionary income more towards their house. And, because now we're thinking about, well, are we going to be officing from home for a while? Now I need a home office. And then on top of that, if you've got kids, the kids might not be going back to school. And so now you got to do everything you do with your life in your house. Yeah. And so it's really been intense for families trying to move, because there's just not as many opportunities for great houses and good school districts as there typically are. So you just see, very much increased demand. And so the good houses are just like, multiple offers all day. And it's pretty tough to get them done on the buying side.
Well, that's very insightful, especially the piece about, I think everyone knows this, especially people that are working from home, but people that have home offices and have their kids at home during the day. that's definitely a factor in the way that people are thinking about buying homes, having a dedicated office space and space to entertain their kids, or a nice backyard for them to run around in while you're working from home. So Tucker, thanks for shedding some light on the psychology kind of the market right now for buyers and sellers. Clint, I've really been looking forward to getting a peek into your world as a custom home builder, especially in the context of COVID. So I wanted to ask you, in what ways has the pandemic affected your business, and how have you had to pivot in response?
So as far as, new starts and build to suit projects, we definitely, when this first hit us, really in March, where a lot of us were being quarantined, we had a lot of clients who just hit the pause button. We had projects ready to go, permits in hand, and they hit the pause button a few months go by, and we all saw things somewhat go back to normal, and people start to get out, and we had projects resume, and now we're sort of shifting back to things looking grim again. Since that has happened, we've not seen any slowdown. Our projects are starting up, and at least on the luxury home building side. I think everyone is seeing the low interest rates, and they're wanting to jump on that, take advantage of it. I think with the lower interest rates, from what I've seen, credit requirements have increased. And so I think for the first time home buyers, that might still be, keeping things, calm or stable, but in our market, it's not really a factor. So yeah, I think they're jumping on the low interest rates. From a design trend standpoint, we've definitely seen a lot of big shifts, kind of like what we did during the last tornado, where we saw a big uptick in safe rooms. Everybody had to have a safe room. Everybody wants a safe room again. Definitely, we've seen a trend in home offices for a while. We're doing second and third offices now because we've got a lot of, dual income folks. Everybody's doing a pool. Every one of our projects is doing a pool and, outdoor kitchen, and no surprise there, right? Home gyms. We've been doing mudrooms and transition areas from your outdoor, your garage to the inside, but we're seeing an even, a bigger uptick on that, because I think a lot of people want, sort of a sanitation area, or, an area where they can sort of sanitize and derobe and discard before they go into the main house. Home air filtration, more and more, smart home features, sound insulation. One of the really interesting thing is we're seeing a lot of the everything's been open, white and bright, and we're actually starting to see a trend more back to more privacy, more doors, more walls, more separation. So some interesting design trends that we're seeing.
Yeah, that's definitely super interesting with people. I think if you can afford a custom home and you're looking at putting things in there that you find useful, it could be indicative of how more people are thinking about their homes. More people would want that if they could make that happen. And so I think that is a unique peek into how kind of the psychology of what's going on right now and what people are wanting in a home. So
yeah, and I think a lot of it is probably overcorrection, and I think they're temporary trends, but I think some of these will stick and will be around for some time.
Well, that's awesome. Thank you for your perspective on that. I want to shift for a minute and get some perspective from an asset manager. Trevor, I'd like to get your perspective on this. I know that you own a portfolio of single-family properties in Texas, and you also manage multifamily properties in a number of different states. So this question's kind of two-pronged, but the first part, I wanted to ask you if you could tell me a little bit about the moratorium that recently expired, and how you were maintaining rent in that time, during that time when you were under that. And then also there are talks of another moratorium being put in place for landlords. What steps are you taking now to proactively position yourself in the event that it happens again?
So yeah, on the first one, the moratorium definitely started to give the tenants a little more confidence. In an odd way, they were kind of getting peripheral information. Typically, it would be from friends, unfortunately, or Facebook or social media that they were under the assumption that they couldn't be evicted for whatever reason. And it's fairly valid assumption because that's essentially what it did. However, what it opened up is a dialogue, for me anyway, with my tenant base, whether it be in multifamily or single family homes. It was opening up that dialogue with the tenants to kind of let them understand the difference between the misinformation they may have heard, or maybe they just didn't understand it versus what reality was. And that communication with them was, to me, the biggest factor in not only them paying rent and kind of being responsible and organizing their priorities, which really is what it boiled down to. That helped me retain rents, keep rents up. And, you know, there's going to be a few people where it legitimately did impact them in the sense that their hours were cut. And again, that goes to communication, them letting me know and me inquiring earlier in the process of a given month. Let's say on the 20th, I reach out to every single tenant one way or another, if it's multifamily through, you know, email blasts, or if it is single family, whether it's through email or phone call, just to kind of have that touch point where I can say, you know, where are we? You know, it shows that, you know, I'm giving compassion and understanding their situations, but then on the same side, trying to get ahead of the game, because it's much easier to kind of plan for a dip in your cash flow from a revenue perspective. If you know ahead of time, you can work out payment plans, stuff of that nature. You know, in looking over the last, what are we, 5 months now, 4.5, almost 5 months, that has been, to me, one of the biggest things, having that relationship, which has really just helped them understand as well my position as a landlord. A lot of tenants might have the misconceived notion that landlords just sit on money, and if they don't pay, they'll be all right. Or they heard the other one that, well, I don't have to pay rent as a renter, and the landlord's not having to pay his mortgage. So, you know, why should it be uncomfortable for me? I'd rather go do whatever and not pay rent because I know the landlord doesn't. But in communicating that to the tenant, that was like, well, I still have to pay rent. So, or mortgage. If you don't pay your rent, I now have to foot that bill. And when they started realizing that, you know, landlords still had to pay, they still had to pay for not only that, but the other services, whether it's multifamily paying for the grounds or the water, or single family having to pay the taxes, or having to pay, in some cases, depending on how you're set up, utilities or landscaping. Those bills just didn't go away for the landlord. And when they started to realize that, I think it helped them kind of reshift their priorities. And fortunately, didn't really have a whole lot of issues. A couple of creative things that I had to do were, you know, if they were close to their renewal, essentially having them sign a renewal that would extend their lease a little bit longer, and I would add on the missed rents over that in a flat, leveled fashion. So their rent increased, but they didn't have to absorb those, you know, month and a half or something like that up front.
Yeah, so actually, I know that there's a lot of downside, obviously, and people are struggling, and it's creating problems on both sides for the landlords and for the tenants. But one of the trends to come out of this whole thing that seems to be positive for the landlords and property managers is that a lot of tenants have been more willing to renew leases. And I know you mentioned that a little bit, but like, have you been seeing that on the single family side? Have people been more willing to renew their leases because, you know, it could be costly to move, or yeah, are you seeing that?
Yeah, so it's a really interesting thing that's happening, kind of like what Tucker had mentioned. You have people who are now realizing, I got to work from here, I have to teach my kids from here, I have to do this, that, and the other. And they start looking, typically from their apartment space, they start looking at their apartment and they're like, I don't have room for this. Plus you have now more kids in the apartments, whereas before during the day, if I was a working parent, my kids were off at school, the kids above me in the apartment, they weren't there making noise. Well, now you have kids, you know, if you're in an apartment of some nature, you might have kids above you, below you throughout the whole day. They are really starting to look at, A, can I buy a house? B, can I rent a house? And that's the big thing that I'm seeing. If they get past that fear of moving, which some people are just kind of I'm not moving until this is settled. I don't know if I can get qualified somewhere else. I don't know if some properties, apartment complexes are not even touring. That's a consistent thing right now where it's virtual and some people don't like that. So you have people staying put in the apartment world, but the ones who are starting to kind of venture out, they're looking at first time purchases. And as Tucker said, the inventory is super low, very competitive, and people who are new to that, it's kind of a shock to them, but they're also looking at single family homes now and saying, well, my rent right now, I think the average rent for a 1-bedroom in Fort Worth this year, Dallas Fort Worth, is a little over $1,000. So $1,060 is average, which is for a 1-bedroom. And now they're looking at, well, I can go get, 3 bedrooms significantly larger, but they can look at, well, I can go rent a single family home, not own it, but rent it. And they're asking for 2-3 year leases because they really don't know. So I am seeing requests for longer term relations on the front end. And I'm also seeing a desire to renew the lease that they're in, mostly out of, they don't want to buy a house. Some people, this is the first time in my experience that the government's kind of assigned roles, which you're essential, you're not essential. And I think people have started to look at their own jobs and their own stability and either realize it's not as stable as they thought it was. And people, when that starts to happen, get a little bit more cautious. So like Tucker was saying, they start saving money. They start figuring out, what am I going to do with this? And fortunately, with the rates going down, you're seeing people who are at least venturing into the conversation of buying a house. And then if they can't find a house, they typically, if they've made that shift, they will go and rent a single family home. But again, to that, your inventory is low on rentals. If you see rentals that are out there, the decent ones, they typically are getting multiple applications on there and they're going very quickly. And that's increased the single family rental rate as well. I mean, you've seen rental rates, they slow down in terms of increases. We were 2%, which isn't a huge amount, but it's 2% over what last year was. And a lot of people would think that rents would have dropped during the COVID, but they actually haven't, at least on the single family side. The demand's just been super high, and that's due to the influx of people wanting to move in. It's kind of the in-between point between an apartment and owning a house. They can get the value of the house, the size of the house, and increase their living quality without being, having that 30-year mortgage in their mind tied to them. So it's kind of a nice intermediary. But yeah, single family homes, people are renewing longer and they're willing to pay more rent right now.
Yeah. Well, you hit on a couple different things. Actually, I just got a question in the sidebar about if we were seeing hesitation at all from potential buyers due to uncertainty in jobs and income. And that's definitely been a reoccurring theme, I feel like, in conversations that I've had in a bunch of different areas of real estate. People have had that concern with consumers being, they really don't know what's going to happen. There's so much hesitation there to just dive into a new, getting into a new mortgage is something that can be scary. So while we were talking about inventory, I know, Tucker, I know you mentioned this earlier, and Trevor just hit on it right now, but in preparing for this discussion, I read that home sales were down about 10% across Texas compared to second quarter last year, which is to be expected because of the coronavirus. But I read in a few articles that homes are selling on average in less than 22 days. So with inventory still so low, and with COVID potentially rebounding, do you see, Tucker, COVID affecting the demand either positively or negatively?
Sure. Well, that's a tough question. It's what we'll see in the next 6 months is anyone's best guess. But I really think the psychology of the buyer and the seller at this moment is, if I'm going to move this year, I'm going to do it, now. And you don't want to get into a situation where if we do see a rebound in October, November, December, we want to kind of have what we're trying to get done before then. And so for us, we're looking at think of it as in the spring market, nothing much could happen in March, April, and so the slingshot of buyer and seller demand was pulled back and couldn't be released until May, I suppose, it started to pick back up again. And so all of a sudden you have this built up demand from early spring movers that didn't do what they wanted to do. You had your regular summer movers, and now, you know, those summer movers are saying, I want to get what I want done, you know, in the next 60 days, or really at this point, it's the next 30, 45 days. And so I think you're seeing, you know, an extreme summer market and a truncated fall market where people are just, you know, like I said, trying to get it done. Whether or not we see an uptick or not is yet to be seen, but they're just planning on, you know, a scenario where we aren't able to, pardon me.
So yeah. Oh, go ahead.
So, you know, how it affects, you know, it does seem like there's less transactions, and I think that's not really a factor of less buyers. It's more just less inventory. I mean, there can only be so many sales if there's so many listings. And so that's really the limiting factor there.
Oh, yeah. I mean, I know just because I have family that just recently sold their home, and I think within 12 hours of listing the house, they had 3 offers. And like, that's just insane. You know, I mean, to me, the speed at which that happened, and the, you know, like you said, it just has to do with a lack of inventory, and I wonder how long that's going to go on for. So Clint talked a little bit about how design changes and people's preferences have changed geared towards COVID. Tucker, I wanted to ask if you've seen any buyers' preferences changing post-COVID. Like, what things are people being attracted to or steering away from when they're looking at homes, when you're showing homes?
Sure. Well, I mean, I'd say the number one thing is outdoor spaces. I touched on this earlier, but you know, everyone wants a pool. I mean, it's crazy. And I know pool contractors are like backed up like 6-8 months. If you wanted a pool at your house, you know, you'll be swimming in it, you know, in 2022 summer. So, you know, it's wild. So I think, you know, everyone's looking for more outdoor space, a pool, you know, somewhere to hang out outside, whether that's whatever amenities it is, built-in grills, pergolas, the whole, you know, whatever there is. Definitely like more home office space. I mean, that shouldn't be a surprise. Other than that, you know, I don't really know if it's interesting to think about, you know, what's the long-term like psychological effect of this, you know, the amount of safety that we're having to exhibit, you know, in our everyday lives now, if that sticks for the long term. So I don't know if it's more like a trend that comes and goes, or if this is a long-term, you know, change in people's psychology. But I think at least the experiment of many companies allowing their employers to work from home, that, you know, there's just a certain ratio of people that will just be working from home because they figured out maybe it works in some cases and maybe it doesn't in others. But, you know, this has kind of forced us into an experiment, and I think the home office space will just only expand. I've heard a couple of new things like Zoom rooms. People are staging these rooms that will be like excellent for making Zoom calls, you know, well lit, you know, nice wall decor or whatnot. And I think that's kind of interesting, just like a room dedicated to making video calls. But, you know, overall, it's really just going to be like, I'd say, outdoor amenities and office space.
Yeah, it's been really interesting to see how people are adapting in different, you know, areas of real estate. I know someone that owns kind of co-working space, and they just created these little booths for Zoom because it was becoming such a, you know, needed and necessary thing today, because people needed that privacy and a little, like you said, well lit, no distracting background, so that they can make those calls. So that's a really interesting point.
Isaac, I'm gonna just follow up to what Tucker was saying. You know, I think that I think the home office will be a long-term trend, you know, which is an agreement with what he just said, because I do think that we've all realized we can be effective and productive from home, and so we're going to see a lot more remote work, you know, for the long run. I think a lot of the safety and health related type stuff, kind of like the safe room and the, you know, the drop zones and all that kind of stuff, I think those are temporary, and maybe I don't give humanity enough credit, but I think we're going to be really quick to forget once we have a vaccine and things get back to normal. I think a lot of that sort of just goes away. But yeah, I mean, he was talking about the Zoom rooms on all of our multifamily properties, which we just do ground up. You know, we're actually incorporating that into the design on everything now. So.
Wow. Yeah, that's crazy. I didn't know that. I thank you for chiming in also on the multifamily side. As we know, we discussed previously that there is a lot of trickle down, and there are indicators within multifamily and just trends of renting that spill over into single family. And so it's definitely interesting and noteworthy. Clint, actually, so I have a question for you about, I know that COVID's caused volatility in the global building material market, especially for multifamily. Including lumber and steel and appliances. A lot of appliances are imported, and a lot of components of appliances are imported as well. So have you seen any of this volatility, and has it been an issue for you as a builder recently?
So we anticipated a lot of price volatility, both on the material supply side and the labor side. We've really not seen it, to be honest, neither, on the single family or the multifamily side. We've definitely seen a slowdown. Most people don't realize how much of our goods do come from China. Hardware, plumbing fixtures, lighting. I mean, a lot of it. Most of the Kohler factories are in China. So we've definitely seen a slowdown. So we're buying in bulk more. We're ordering materials early and storing it. On both the single family and the multifamily side. But as far as, cost volatility, we've not seen it. Actually, it's remaining pretty stable, and we're actually forecasting that some of our big line items are going to, actually come down in the next 18 months.
Oh, yeah, that would be a positive trend. So how would that affect, how does that affect your clients or affect you as a home builder if prices change and they fluctuate a lot? Obviously, there's going to be a cause and effect, but I wanted to understand a little more of the correlation. Like if prices go way down, does that just help margins and help you be able to, do more projects and give deals, or could you explain a little bit about the correlation between prices and materials and what you offer?
So two different paths, right? I mean, on the single family front, most of what we do is in the high end kind of luxury market, so it's not really a factor. I mean, I definitely think it's interesting, and it might compel some of our build clients to do a little bit more than they had anticipated. We're sort of an open book cost plus builder, so I don't really benefit from that necessarily. It's not like I'm making that extra spread. On the multifamily side, it has huge impacts on us, right? Because you're talking $40 million projects, and a small swing in lumber or concrete or steel can really hurt us.
Yeah. Well, so I want to direct a question to Tyler. We did hit on actually I think Clint was bringing up a point about borrowers and requirements for borrowers. So I wanted to ask you, what are the biggest hurdles for borrowers right now? Like, in what ways have requirements changed for applicants since COVID hit?
Yeah, so I would say obviously some of the biggest changes are increase in credit score requirements. So we had loans in the past where you could do a 600 credit score or a 580 credit score, and a lot of the lenders we work with and lenders across the nation increase that to 640, 660, or 680. Even Fannie Mae and Freddie Mac, they have an automated system that will take all these data points and approve a loan or not. Well, they tightened up the requirements on that. So that's an algorithm that has a lot of different factors. So even if you have a 690 credit score or 700 credit score, if you're putting a small down payment or have a lot of debts relative to your income, you may not be approved, where a couple months ago you would have been approved. So in times like this, like I've had clients who I pre-approved in February or March, and then they were looking at houses and found a house in April or May, and we go back to their loan and now they're not qualified because of some of those changes in requirements. So credit scores are one. Lenders are definitely wanting additional reserves, especially with investors. So they want you to have more assets, more savings to make sure that if your tenant stops paying, or if you do lose some income or get furloughed, that you can still make that mortgage payment. They don't want you to buy a brand new house and then request forbearance the next month.
Yep.
Like that's not a good situation for the lender and the lender's liquidity. I saw a question come through on the panel here that I'll just answer real quick too, because it ties in with that. So it says, I know that the dip in interest rates have enticed some buyers, but do you guys see any hesitation at all from potential buyers due to uncertainty with jobs and income? Has that fear been voiced to you by clients that were debating on buying during this time? So at NXT Mortgage, we saw it a lot in March and April. We had clients, like I mentioned, maybe pre-approved before and then they couldn't get approved. But this is more maybe the motivation of the buyer having hesitation. And we had multiple contracts fall out when this hit, whether it be people who actually were furloughed and could no longer qualify. I had people who were furloughed but still qualified, but decided that since I took a 10% pay cut or a 20% pay cut, yes, I could afford the house, but I don't really want to buy the new, bigger house. I'm just going to stay put for a minute. So I saw a lot of that. I'd say probably 10% of our active loans in the pipeline in March and April withdrew or held back because of that. We had people out who were looking for homes who decided that they're just going to put on hold and I'm just going to rent for another year and I'll buy next year. So some of those first-time buyer people decided, hey, I don't know what's going on. Millennials, people my age, we saw the housing crash. The only recession we know was the housing crash, 2008, 2009. So as soon as everyone starts talking about stock markets going down and economic crisis, we automatically just think that home values are going to crash. So I don't want to buy a house right now for $200,000. That's going to be worth $150,000 in a couple months. So I think there was a lot of fear that deter some people. Now I'm on the mortgage side, so usually people come to me, they want to buy a house. Now I need a mortgage. So I don't have a full spectrum of the population, a full sample size to know what the other 95% of the people, if they do or don't want to get in the market space. But yeah, there's definitely been some impact on our end, people losing jobs and people losing income, or just that fear of it that sort of put things on hold. And as like Tucker mentioned as well, the same with the people listing the houses. They're like, okay, well, I don't know what's going to happen this year, so I'm just going to wait till next year till I sell and buy again. So that's causing some of the inventory constraints as well. So hopefully that answers that question.
Yeah, and it does seem like it's caused people to kind of go one way or the other, like sort of in extremes as far as people, encouraging people to act faster. I need to get a home, prices are going to go up, or people are going to be moving into Texas and buying up everything. I need to get a house now. And then also people that are playing the conservative game and hoping that that they'll be justified in waiting until next year to buy a home or to get a new mortgage loan. So yeah, obviously lots of things affecting the appetite of buyers, borrowers, and sellers.
I could add to that a little bit.
Yeah,
I think I get this question a lot too, and really for the past like 3 or 4 years, price appreciation and on a pretty steady and vigorous path. And so, many first-time buyers just, exactly like Tyler said, that the only recession we know is the Great Recession, right? And so when we were growing up in our parents' house and our parents just went through this, financial meltdown. And I think it has given us some like PTSD in some kind of way. And, so, people in that 25 to 35 bracket are saying, do I buy now, or when's the market going to dip so I can buy? And it's the same sort of psychology that you see in stock market investors. They're saying, well, when I'm trying to buy the dip, when's that going to be? And try to time the market. And, timing the market is just not something that really works 99% of the time. And I think in Dallas, especially, most of our price appreciation is driven by population demand, or population increase, sorry. So, 100,000 people move here every year, and it's been that way for the last 5 or 6 years. And so, if you add up all the housing starts and you add up the amount of transactions there are a year, and you say, okay, I have to, have this consume 100,000 more people moving here. Now you have to say, well, probably 65, 70% of those people rent, but then that maybe goes to Trevor's point on, single family rentals increase and multifamily as well. But, in the future, it seems as though Dallas is only going to get bigger. And especially if companies from the coast keep moving here, for just more economical balance sheets for their businesses. And if business gets tougher, you only really see that increase as companies try to cut their costs and find places that are more economical for their business. And so to me, it's just every time I have that conversation with somebody, we wait a year, and then the same house that they were trying to buy is now 5% more than it was last year. And it's tough to kind of time that market. But I think it's really, instead of looking at, well, prices are going up, ask the question, like, why are the prices going up?
Right.
And not necessarily just that, that they're going up. I mean, it's just because that way you can look into the future and say, where is it going to be 5 years from now? Now, like the entire country, obviously, it's impossible to know when that's going to happen. But if you look at how Dallas performed in 2008, it was pretty steady. And most of that is because of many different companies being here,
Right.
and sort of a really diverse workforce that keeps the market relatively steady. And, it dropped 20, 25% in some areas of town, but it rebounded within 2.5, 3 years. And so, I'd say those are important things to think about when you're looking at that first time purchase.
Absolutely. I mean, just again, like those were, there are a ton of, obviously, I'm just echoing again, there's a ton of factors affecting the appetite of people in the market. And you get some people that I'm sure buyers and sellers on all sides of the spectrum, but there are people who are very conservative and people who are geared to make good decisions or prudent decisions. And so we get a lot of, it's been an interesting conversation as I've met with lots of realtors and loan officers and getting people's perspective on the appetite and the psychology of buyers and sellers. So while we're on the topic of appetite, I wanted to ask Trevor, how has the instability of the market beginning at the lockdown affected your appetite as an investor? And I know Tyler, you invest as well, and Clint is involved in that too. So could you comment, Trevor, on how your appetite specifically has changed since the beginning of the lockdown?
So, I mean, from an investor standpoint in single family homes, it really has not changed much in terms of the risk versus reward, because I've seen it as less of a risk in this scenario. The downside right now is the cost of houses. Just the demand is very high. So if I'm looking at a purchase, whether it's kind of a wholesale deal or if it was, just straight buying off the market, off MLS or something of that nature, you are seeing housing prices higher. But in terms of the demand for that house in the rental market, the rent that I'm able to get off of the home has increased, which helps kind of offset the increase in price from the home. I know a lot of the people I help that they might be first-time investors or working with wholesalers, or they're leaving their first house and they're trying to figure out how to transition, leaving their first house behind while acquiring a new house to live in. They have a lot of questions on the biggest concern. How do I rent this? Right now, are people moving? They're kind of concerned about touring it. How do I tour safely in COVID? And that goes to even open houses and stuff on the sales side, but on the rental side, that is an aspect of it. And that's something that kind of had to overcome. And that was one of the more trickier things, is how do I market this rental to get the highest price that I can and still get a qualified tenant in there that, I'm going to be happy with. And that was probably the only real hurdle, is kind of tweaking, how to work in the COVID environment and still follow all the things we have to follow with fair housing and all that, and still be able to maximize the rents on there. So in doing that, you know, I kind of changed the way that I would do showings and try to make it much more scheduled and blocked, and have people come in and have like personalized tours where there was distance given and they would kind of do their own thing and come back and we would correspond, opposed to the kind of the old style way where it might be kind of sometimes more open house-ish, because you would have 30 something people interested in a home and you just couldn't squeeze that all in one day. And now people are significantly more apprehensive in terms of viewing. So that's probably the only tweak. But other than that, the rental market is strong. The people who are wanting to rent, again, they have more money. These are people that could own a house or want to own a house, but they're more concerned, or maybe their credit score has kind of gotten them in the way now. Like Tyler said, you know, someone with a 580, 600, you know, they would have went and got an FHA loan at one point, and now they're not able to. So they're a little more apprehensive, and now they're just going to go rent until they figure things out, or whenever things start to get a little bit better. But a great thing is that it's given an opportunity through the interest rate side to look at refinances if you have an investment home, because even if your rent, let's say you had a tenant and they signed a long lease and they're on a 2-year lease, there's not a lot you can do to increase your cash flow monthly that you can do because they have a lease in place. I can't increase, you know, their rent. I can't add a certain amenity on there that might charge them a premium. But what I can do is refinance and take advantage of a lower interest rate, which all that's going to do is basically lower my payment monthly, which will give me more cash flow. So I've seen a lot of investors right now that, you know, they had a buy and hold that they were holding on to, and they felt good about their cash flow on that property. But when they see their rates were, you know, higher and they're able to move it, you know, 1% or something like that, that's real money. And the thing is, most investors will look at bottom line. If they're saving $50, $80, $100 a month, that's very impactful. Tyler will be able to speak more on the effects of, you know, getting the interest rates down on investment properties, because there are differences, and obviously a primary residence versus an investment property. But a lot of people, you know, a year ago, like Tyler said, they might have purchased that property last year as an investment property, and they look at rates now and they can get 1% lower. They're going to do it all day long, because it's really all about the numbers. So that's been very encouraging in this COVID world that we're in now, is, you know, take advantage of the interest rates, because it's potentially a one-time thing that we can do. Because if rates go back up, the investor's not going to refinance that house at that point. It's just not worth it. But right now, in a lot of instances, they are. You have people who have had loans or buy and holds for 7 years, and now rates are just killing it compared to then. So it's definitely something I encourage anyone that's an investor, at least look, because that's a way to just increase your cash flow. And that's been encouraging.
So on the topic, oh, go ahead.
Yeah, I was gonna ask if I could comment in on that a little bit. So Trevor sort of beat around the bush, and I'll put his business out there a bit. So he recently purchased an investment property. I know, because I was a loan officer. So I guess that hasn't really deterred him from investing. Personally, I also purchased an office building for our company. So at a time when people are moving away from offices, we needed a bigger office. So, you know, this isn't really a commercial real estate discussion, but that was interesting, you know, the thought process behind that. But there was a question here that correlated with Trevor's that I wanted to answer about, do you tend to see rental rates correlate with housing prices? If home prices dip, is that going to negatively affect rental price? So sort of tying in a couple of the points we talked about earlier, you can buy a $283,000 house for the same price as a $250,000 house, same monthly payment, this year versus last year. And so if I'm an investor, and as Trevor mentioned, you get this mortgage, you're charging $1,500 a month in rent, it costs you $1,200 a month, you're making $300 cash flow. Now, if you refinance, you save $100 a month, your cash flow just increased, so you don't need to increase your rent. On the same side, if I bought a rental property today and Trevor bought one last year, And now I'm buying a house for $20,000 or $30,000 more because the prices have gone up and demand is up right now because of the short supply. My rent price doesn't necessarily have to be higher because I'm borrowing the loan. My $280,000 house has cost me the same as the $250,000 house that Trevor bought yesterday or last year. So I could charge the same rent price on a higher priced home and still make my margins as an investor to where it's a profitable investment that I want to do it. So as long as those numbers make sense. And then also to Trevor's point, I think that only lasts as long as interest rates stay low, because if the home prices go up and interest rates start ticking back up, now as an investor, you've got to charge more rent to cover that spread. And then the investor on like a single family side they're always competing with just retail buyers trying to purchase a home. So that drives some of the price there, and may or may not make a certain home attractive from a rental perspective.
Yeah. And I was going to piggyback on the question. I saw it. You know, if home prices dip, is that going to negatively affect rental prices? I can tell you in that scenario Tyler made where, well, let's say my cash flow was 300, I refinanced, was able to further that and make it 400. If the guy next to me is renting a similar comp or a similar house for 16, I'm not going to stay at 15. As a landlord, you're going to balance the quality of tenant, you know, because raising someone $25 a month is $600 a year or $300 a year. Sorry, it's not worth losing a tenant. Your largest cost on any rental or buy and hold is your turn cost. So if you minimize your turn cost, you look at it and say, well, do I want to lose this tenant for $300 or not? Almost answer always is no. But if for some reason Tyler's house that he bought this year, because it costs more, he's having to charge $1,750 a month, $1,800 a month, and he's getting it. And I'm over here with a similar house at $1,500 or so. Yes, does it make sense for me to risk possibly losing that tenant to have a higher cash flow? For sure. So I don't think as the rental market or as the housing market, the prices go down, let's say, I don't think they will much, but if they do, you're still going to see rents hold, mostly because they're competing against other landlords and most notably multifamily. If you go and look at a 3-bedroom or a townhome in an apartment complex and it's renting for $1,800 and your house is nearby and it's, obviously it's more private, it has possibly 1 or 2 car garage, it has a yard, you will get that or more no matter what. I mean, it's going to happen. So the multifamily is a very good indicator of where your rental prices are going to be, regardless of what you bought the house for or what the house is worth today. So that's something to keep in mind when you're looking at the adjustments and fluctuations in the value of the house. But Tyler was right. If no investor is going to buy a house today where it's $1,500 and they're going to have their rent at $1,500, they're going to try to bring that up. Whereas someone a year ago, the rental market might not have called for a higher rate, but they still would have tried to cover at least what their monthly debt is going to be on that.
So I know that we're closing in on our hour here, but and I literally have hundreds of questions I could ask you guys. So Trevor, you were talking about the most expensive thing in investing for a landlord is the turn cost. It's getting it ready for the next person, and involved in those, just like I saw when I actually got to visit one of your properties the other day, was the subcontractors that were there that were fixing things and painting and doing the floors and stuff. And so, but it made me think of something Clint and I, Clint, we were emailing the other day about subcontractors, and you were saying that there's, it's important for builders to have a good handle on the do's and don'ts of subcontracting. But as it pertains to COVID, has there been any, and all of you can answer this, but has there been any change in the pricing or availability of some subcontractors, or has there been any effect on the bids? With there being so, like Tucker mentioned, pools that it's impossible to get a pool right now because every pool company is booked up right now. Have you seen, Clint, anything on the subcontracting side that ran into any issues with getting people to do jobs for you as a builder?
So on the single family side, most of our subs have been with us for 10 plus years. And so we've not really seen an impact, but I don't know if that's really a good indicator. On all of our pool projects, including our personal house, which is going on right now. Yeah, I mean, pool companies are backed up for obvious reasons. The city's backed up, and there's a 14, 15 week, delay on getting your permit. And that's slowing things down. On the multifamily side, we're seeing our phone ring a lot. Actually, we're seeing this on the single family side as well. So our phone's ringing a lot lately with subs calling, looking for work. And that hasn't been that way for many years. So it's interesting to see that. And I mean, I think the key reason is you've got a lot of starts that were put on hold and are still on hold.
Yep.
On the multifamily side. And I guess probably on the single family side as well. So,
yeah.
I would expect that labor is going to start to get a little bit more competitive because of that. It should. So.
Yeah. Well, thanks for touching on that. That's kind of where I wanted to get, was about the trend of availability and pricing of those as like you said, more projects were being put on hold, people looking for work. Maybe that'll be a positive trend for people like Trevor and for you, Clint, on the multifamily side, and anyone that's investing. Well, we are closing in on our hour here. I want to open it up just for a few minutes. There are a few questions that were in the queue. If anyone has any questions, you should type them now, so we have a few minutes to answer that. But if not, I just want to thank. So we do have a question about vaccine. So how soon after, this is for anybody, how soon after a vaccine is approved and administered do you think the quantity of listings will come back to normal range? Seems like listings have been tight for a very long time, and with people continuing to move to Texas, there will be enough supply. Will there be enough supply post-COVID to meet demand?
So I'll go first. I'm an optimist. I think within a few months after we have a vaccine that can start being, that's publicly available, I think there's a lot of pent up demand. There's a lot of sorry, I had a kid walking in. There's a lot of there's a lot of pent up buyers, and not only that, we as Tucker pointed out, we've got a shortage of inventory. That's going to continue to be the case. It's only going to get exacerbated because we've had a lot of stuff that's been put on hold for a while. So I think it's going to go gangbusters personally once things get back to normal. Oh, and I also think that, if you look at, and Trevor can speak to this, or Tyler, sorry. If you look at what the government did in terms of buying up long-term bonds, back during the Great Recession, you're seeing that huge spike again, tenfold over what they did, back in 2008, 2009. And that's an indicator that this is pretty significant, and it's typically an indicator of interest rates. And so, after the Great Recession, we saw interest rates stay low for a long, long time, many, many years. I think that's going to be the same case again. And I think that on top of everything else is going to be really good for single family. Personally, I'm really bullish for the next 8 years on single family.
Yeah. Well, thank you, Clint, for that insight, and I think some of our other panelists would agree with that projection. I do want to be respectful of everyone's time, and I want to give a huge thank you to our panelists for making time to speak today. So on behalf of MBL Title and myself, I thank you so much for sharing your experience and your wisdom and your outlook with all of us today.